I think if you don't constantly innovate and adapt and try to figure out the new thing and how to implement that and combine it with the rest of your things that you do well, you become mediocre and eventually you get passed up.
This show spans global markets and institutional investments through conversations with some of the world's leading investment, economic, and philanthropic minds.
Welcome to the FEG Insight Bridge. Today we are going beyond the pod. I'm joined by Dmitry Balyasny, founder and managing partner of Balyasny Asset Management, one of the world's leading hedge funds. Since founding the firm in 2001, Dmitry has helped build BAM into a global investment platform. Along the way, he's earned a reputation not only as an accomplished investor, but as a builder of talent and culture. In today's conversation, we'll discuss Dmitry's journey from immigrant to hedge fund founder, the evolution of BAM, what differentiates the firm in an increasingly competitive landscape, how technology and AI are changing investing, and his perspective on the future of hedge funds. Dmitry, welcome to the FEG Insight Bridge.
Thanks, Greg. Good to be here.
Thanks for joining us. Hey, would you mind just briefly introducing yourself and BAM?
Sure. Dmitry Balyasny. I started Balyasny Asset Management with my partners almost 25 years ago in Chicago. We've grown into a global multi-strategy firm. We have about 2,600 people on the team around the world in a host of different investing strategies and try to put up consistent uncorrelated return for our partners.
And we're going to get all into that, but I wanted to start at the beginning. You have a great story, sort of the immigrant story. So you immigrated from Ukraine at around age 7.
Yeah.
How did that kind of set you up in life? In terms of just being an outsider coming in? Tell me a little bit about that.
Sure. Well, first off, as always, have to thank my parents for that one. Courageous, move on their part, leaving everything they knew, behind and going to something they knew, nothing about. It's kind of hard to imagine today in the age of AI when you can click in any question and you instantly get all sorts of details about anything. But at the time, like they had, this was the late 70s, they had no idea what the rest of the world was like coming from, the former Soviet Union. You just had a lot of propaganda and not a lot of ways to really verify any information. So I have to thank them to start. For me, I was a little kid, so it was definitely a big transition, like learning the language. I started in 3rd grade. I didn't know how to speak English. I got sent back to 2nd grade. Then I figured out how to speak English a little bit. Then I got moved to 4th grade. So I tell my little kids I never actually finished 3rd grade. So it was, it was quite a transition. I think in terms of formative aspects, it definitely helps with, kind of grit and perseverance and things like that, because, you had to work for everything from scratch and kind of really figure stuff out.
I mean, a lot of Eastern Europeans in Chicago seems like a destination. Was there another reason why they chose Chicago?
No, these things are so random. I mean, we had relatives that wound up in Israel, relatives that wound up in Australia. Some people wound up in South America. In the U.S., it was really mostly a choice between New York, L.A., and Chicago. And my grandparents on my dad's side came over a few months before us, and somebody told them to go to Chicago, and so that's where they wound up.
Probably like the 3 cities they actually could name, right? Coming from the Soviet Union at that point in time.
If they could name 2 out of 3, I think it would have been pretty good.
So when you're growing up in Chicago, as you said, you didn't know English, right? You kind of had to learn and go from there. Did you have when did this investing thing come about? Were you always interested, or did this come about later in high school? Or
I became aware of markets in middle school. We had a stock picking contest, and I was intrigued, and I got lucky buying penny stock that wound up tripling. So I won the contest, but later on the company it was already in bankruptcy and it went to zero, which I didn't realize at the time. But it intrigued me, and I started kind of reading up on investing in markets, and I was always interested in business. And I started taking earnings from various part-time sales jobs that I had growing up, and starting to invest those initially in mutual funds and then eventually in equity.
You then go and get a job as a stockbroker?
Yeah, I did a lot of different sales jobs in school because I figured out that was the only way you could get paid a percentage of what you produced. And I didn't really want to work for minimum wage. So I was looking for other sales jobs, but something ideally closer to the investing world. And I learned that you could get a stockbroker license at 18. And so that's what I did. And I started with a very small Chicago-based firm who were kind enough to take a shot on me, and started, cold calling random people around the country about random stocks.
I mean, just think of that, like random calling, right? Nobody cold calls anymore. No one does, probably the rotary phones, dialing. And
It's a lost art.
so you go to Loyola of Chicago, right? And then eventually your first jobs with Schoenfeld Securities. Kind of a famous place, right? I mean, kind of a pioneer in prop trading. What did that experience teach you?
I guess the common kind of trade, I would say, between the brokerage and other sales jobs and Schoenfeld was the kind of perseverance that they required. So I think sales in general is a great background for people, whatever they wind up doing, because you learn how to grind and you learn how to take, rejection and figure out, how to modify your approach and, get after it again, and you get paid a percentage of what you produce. So all those things were pretty similar to trading. And so when I started Schoenfeld, it was after I'd been trading on my own while being a broker, and I was constantly losing the earnings that I was making as a broker by trading for myself. And I really wanted to learn how to trade properly, and I was lucky enough to get that opportunity. But it came with a base compensation of zero, and so the first year I didn't make any money. Literally zero. Not like I didn't make money like getting a percentage of profits. Like there were no profits. So that kind of weeds people out, like the people that aren't really passionate about it and don't have the the fortitude to stick with it and the confidence to keep betting on themselves, get weeded out. And then after that, there was a good learning environment if you were kind of proactive about finding more experienced traders who were doing well and asking them kind of what they did. And I picked up different bits and pieces from people and developed them into kind of my own approach that worked at the time.
A lot of gumption though to take that and then go to open your own shop.
Yeah, it was a journey. So we went from I went from like an individual trader. Let's back up from an unprofitable individual trader to to a profitable individual trader. Then after that, I asked Steve Schoenfeld, who's the owner of the firm, if I could hire people to trade underneath myself, which wasn't like a typical thing that people did there, but they had a few people that did. And he said, sure, if you want to pay for them, you hire whoever you want. So I took that as a yes, and I started hiring people and allocating some of my risk capital to them. So I kind of learned the initial disciplines of capital allocation and risk management through that process. And we developed a group over a few years that was consistently producing very good returns. And then the other thing I did at the time was allocate to other hedge funds. So I was earning good wages as a percent of my P&L, and Steve was kind enough to let me co-invest with him. And when I said, great, I'll do that, I realized that I'd signed up to be the fund-to-fund analyst as an evening job. And so after trading hours, I would call and meet with all sorts of different hedge funds and figure out who we should allocate to. And that was really interesting because a lot of the people who've become very successful over the last 25 years, like we were early investors with, and got a sense not of the secret sauce IP, but the basic kind of approach of how they went about it. I remember cold calling Renaissance and seeing if we could get capacity, which they eventually laughed me out. But a lot of the multi-strats, a lot of the best quant firms, we were an early investor with, and that was formative in kind of how we wanted to build our own business. I learned that the firms that tended to stand the test of time and put up consistent results over time had lots of different risk takers, lots of different strategies. And so that always, appealed to me, and not just being, the only PM or running, all the capital yourself, even though that's how we started. And so we went from that to then hiring, fundamental analysts, and then to becoming a division and then a separate, fund from there.
Just, when you start your own firm, I mean, you obviously have built a lot of the investment skills that are important. But then when you leave and put out your own shingle, you got to raise capital, yep. Right? And you're this, immigrant son, didn't finish third grade, didn't make a lot of money in his first few years. Like, who's giving you money? Like, how did you convince people to give you money?
I really think the way we started is a reasonable way to start, which is with your own capital. So I basically took, the earnings that I was making, and Schoenfeld, matched me, and that was our initial trading capital. And that's kind of how we started. And I think that's a good way to start, right? Because when you're managing your own money, like, you're very on top of the risk. Everything you're doing is with a focus on return on capital. And that's how we ran it for the first couple of years. And so by the time we went out to raise really third-party capital in any type of scale, we had a good track record, and we had a bunch of people, and we had some back office, et cetera. But that process was very challenging. We'd never managed institutional capital. We did what hedge fund managers at the time typically did, which was go to Geneva. We basically went door to door and raised the initial institutional capital from that. We promptly had a 10% drawdown, and we found out that institutional investors did not appreciate that, as opposed to was kind of typical for running prop capital at the time, because you're shooting for more leverage, bigger returns. So we learned a lot from that process, and we had lots of ups and downs on figuring out the right way to partner with institutions over time. And that's evolved. And today we have a very strong investor base. A lot of the biggest institutional investors on the pension side, sovereign side around the world, as well as families that have been with us for a long time. But that's definitely been a process, and you kind of learn and get the right people on the team over time to do that.
So we've kind of hit on some of the elements of it, but we should probably define for those listening what is a kind of multi-manager or pod shop, as you're often referred to.
I don't love the term pod shop because I think it kind of devalues what the business actually is, and it gives the impression that basically you just kind of hire people and give them capital and hope for the best. There's certainly an element of that, and we definitely do a lot of hiring. But what people don't appreciate is kind of the business of the business, right? There's a tremendous amount of effort that goes into building all the infrastructure, all the central P&Ls, the technology, the research, the data, the AI. We have 2,600 people. Almost half of them are on the business side, right, where they're not actively investing. So you really try to create a platform upon which you can build different businesses. And those businesses are, long short equity or commodities or global macro or quant, arbitrage, all these different businesses, and every year or two you're trying to extend them to the next kind of logical sub strategy where you can continue to find uncorrelated strong returns and improve the market intelligence that you're getting across the platform.
Maybe it's kind of pulling on this thread a little bit longer and kind of how it works, right? Because if these strategies, these handful of platforms that you're a part of have done very well, right? Produce amazing risk-adjusted returns for multiple decades. But like theoretically, I always scratch my head a little bit, right? Because especially early on, and we'll talk more about BAM and how you've evolved here in a little bit, but when a lot of these started, they were predominantly equities in large liquid equities that in academic theory should be the most efficient areas of the market. How do you produce all these amazing returns?
Yeah, I don't really agree with the academic theories, which is why I think academics are in academia. There's a trade-off between liquidity and efficiency, right? So if you're picking, smaller cap equities, for example, to stick to the equity example, you have much higher trading costs, and your ability to cut your losses or change your mind is much more constrained if you're trading size than if you're trading larger cap equities. So the kind of informational efficiencies and the kind of delta versus expectations that you can figure out might be larger, but usually that's offset. And so majority of RP&L, and I think that of most large funds, tends to be in the largest strategies and in the largest securities within those strategies. Now, as the markets have grown quite a bit, so the equity markets, the market caps, you could pick your favorite tech stock. The kind of market caps we have today were unheard of 10, 20 years ago. So there's a lot more market cap, there's a lot more liquidity, so you could trade a lot more size, right? And then there's lots of other strategies, whether they're currencies or rates or gas or power. A lot of these weren't that big of markets if you go further back. Things like, index rebalancing has grown, quite a bit, right? And newer strategies that are enabled by better infrastructure, like all the quant strategies and things like that, where you could do them on bigger scale today than you could before. So we try to spread the bets across lots of different teams and lots of different strategies.
I hear you on your kind of, hey, I don't love pod shops. I prefer platforms, and maybe platforms a much better kind of terminology to use, because, if I think of the success that you have produced and other organizations to a certain degree, there are a few things that I think are maybe exceptional or different than maybe other hedge funds. For a platform, you need talent, you need risk and portfolio construction, and you need like great infrastructure. So I'd love to talk a little bit about those maybe three pieces. Maybe the first being talent. Like, how do you assess and then recruit talent to come to Balyasny?
Well, it starts with your reputation and what your offering is to the talent. So it's incredibly competitive. So to avoid being negatively selected, you need to have a compelling value proposition to the talent you're trying to recruit, right? When people start funds, oftentimes they have, very nice, diagrams and PowerPoints of everyone they want to hire in a fairly short, period of time. But to do that without getting negatively selected is incredibly hard to do. Like you have very strong competitors in all the different spaces. And the people who you want to hire are not really looking for jobs, right? Like they have good track records. They're doing well wherever they are. So it starts with your reputation and the value proposition. So for us, we've always tried to combine like the best of a platform offering in terms of access to a lot of capital, the best infrastructure for your particular strategy, large resources and quantitative research and risk, portfolio construction. We have outstanding AI capabilities, et cetera, with the best aspects of a smaller, traditionally single manager fund, which are culture. Like we try to have a really strong team partnership culture. We have 20 partners today split across management and top portfolio managers. Collaboration across, within strategies, across strategies, and very much like a learning, improvement type of environment.
I should point out that is different than other shops where there's collaboration is kind of prohibited. They want everybody to kind of have their own ideas and not share it. So that's kind of unique.
I have a different philosophical view there. Like, I don't think that encouraging collaboration typically leads to groupthink on individual ideas. It can, but it typically doesn't. And the reason for that is, one, you're hiring specialists. So, just because, a tech PM likes a particular AI stock doesn't mean your healthcare PM is going to go buy that stock. But the insights in how the AI is kind of getting rolled out might lead them to think about something in their space, right? And understanding the sector rotations and kind of catalyst roadmaps might be helpful for them, and timing into some of their ideas, right? So that's one. And then two, there's a lot of process collaboration as opposed to a particular investment idea. Right. So we really try to spread kind of best practices around, whether they're, risk oriented, research oriented, AI oriented, people development. There's, a million things that you don't necessarily need to reinvent the wheel on, like somebody might have figured out a good way to go about that. And there's a lot of collaboration across strategies. So if there's something going on in rates, that's significant, that's going to impact the equity market at some point, and you better have an understanding of what's happening there. And you're more likely to have that understanding if you have a strong in-house team that's kind of sharing their views as opposed to just hearing what's being published and from the street. Same thing from commodity markets, et cetera. And lastly, like if you're hiring senior people who are strong in their spaces, like they disagree more often than they agree. So if you put, 5 PMs in a room to debate a stock, like you'll typically get 5 different opinions. And if they all do their own work and come to the same consensus, like usually that's a pretty good signal.
Do you think that your time at Schoenfeld and picking some of the other traders' brains on like how to actually make money helped you to kind of form a culture that is a little bit more collaborative than some of your peers versus if your first job was somewhere else?
I think so. But at the time, they were much more of a generalist trading firm. They've evolved quite a bit as well, and now are much more of a specialist firm also. So it's much riskier to do that within a generalist firm, right? Because the best practice stuff is great, but the market views within a generalist firm are riskier, right? Because you can't have a lot of people lined up with similar positions. Whereas when you have lots of different strategies and geographies and specialist PMs, the risk of that is lower just because you're much more diversified by design.
Before we kind of maybe move on to kind of some of those other areas, portfolio construction or risk management, you know, you've spent a lot of time, acquiring talent, and part of the attraction is your culture. Some of it is your infrastructure. Where does compensation come in?
Well, it's important to get right, and we spend a lot of time on it. Um, we try to align it with what we want to allocate our own capital and our partners' capital, which is the best way to reward consistent long-term performance. But also, you want to have a structure that is stabilizing for the team. So you need to have some sort of downside protection as well. When I started, like, the teams were much smaller, and you didn't really need that. But today, as people are managing much more capital, and this, is much more competitive and efficient, the average team is kind of 5 to 10 people, right? And so being able to support the hiring of best-in-class people, their development and promotion, and the stabilization if somebody's having a difficult period are all important, in addition to the usual, kind of upside incentives that are aligned. Those are pretty cleanly aligned with putting up returns, for the fund, right? We've experimented with lots of different mixes between kind of central and individual comp. We found that most top performers want the majority of their comp to be paid based on their performance, and it's cleaner and easier, and there's less, arguing. And so we have a structure that enables that.
So you get the talent, you figure out the right way to compensate them that kind of aligns the interests of GPLP. Then you put risk management and portfolio construction around that. Maybe talk a little bit about how you think about that.
As part of the process, when we're bringing somebody on and evaluating them, you're basically iterating on a business plan together. So they're presenting what they currently do and what they'd like to do, right, in the form of a plan. And that covers, their team, their universe that they're trading, the research process, the portfolio construction, sample portfolios. We look at their old attribution, correlations, et cetera. And we iterate on the plan with them. And typically it's a phased approach of, here's kind of phase one and the initial team and the initial amount of capital that we allocate to them. That's going well and you're hitting your targets. Here's how we're planning for it to grow. And then you kind of get to phase two of, building the team and the business, which usually involves additional hiring, additional coverage, additional capital. So we try to align on that. And if they have, real business building ability and ambition, there could be phase three where it's a much larger group. We have some teams that are, 20 plus people on the team, cover a wide variety of instruments in their particular area of specialty.
Now, you've only talked about really the right tail distribution. You even talked about, you talked about performance is good, will give you more money, you can build your team. How do you talk about the left tail, drawdowns, correlations?
It's pretty rare that somebody gets stopped out. It does happen, but it's pretty rare. Most of the time, somebody's just not doing well enough for an extended period of time, right? And in those cases, like, we're giving them a lot of feedback on what we see from, the risk side, from the strategy side of that business, in terms of maybe it's the portfolio construction issues, maybe it's risk issues, maybe there's something in the research process we can iterate on. Maybe it's when we look at the attribution, maybe there's somebody on the team that's not pulling their weight, and we can look to upgrade that. So it's an iterative process. We look at ourselves as like a venture partner, right? Where we're taking a defined amount of risk. We're growing the risk if somebody's doing well. And we're iterating with them how to turn it around if they're not doing well. But if a period of time passes and we're not seeing the results, then we have to move on. Like, we're in the business of putting up returns.
So we talked about the construction risk management. I guess the last thing is providing them great infrastructure. And I think and there, infrastructure can mean a lot of things. It can mean trading, but I wanted to talk a little bit more about mainly about research. I mean, some of the things you've done, especially with AI, are pretty cool. Do you want to kind of share some of that?
Yeah, I think this goes back to like the value proposition when you're asking about on the recruiting side. Like if the only thing you're offering people is a sign up check and that's how you're trying to differentiate, that's a very hard game to win. Like maybe you could do that if you're the biggest, but beyond that, you're going to get negatively selected because there's always someone that's willing to match or pay more, right? So having centralized infrastructure and research and resources that enable people to generate more P&L with the same risk allocation and more consistent P&L because the resources they have access to are better than across the street. That's a real differentiator, right? So that starts with, collaboration across, all the different spaces, but then also like all the centralized groups. So we have a geopolitics group, we have an economics group, we have a proprietary research group that does individual projects in collaboration with the investing teams when they want someone to go make 500 calls on a particular subject to see if they could figure it out better than someone else. That's very time consuming. We have the manpower to allow them to do that. Right. We have, very strong AI team that's a central team. And then we have people that we assign to individual teams. And they build, again, in partnership with the teams, they build a whole host of tools that enable you to improve your research process. So some of them are productivity tools. Now they're kind of moving up the stack towards more research tools. And I think it's going to be an advantage for a period of time. And then eventually that'll be table stakes and you have to kind of, figure out the next thing.
Does it change how you invest or just improve the process of investing?
I think it improves the process. I kind of think about it like when other waves of kind of investing innovation have come, right? So if you think back 25 years ago when we were building out and our peers were building out long short businesses, like getting teams that built their own models was a big edge. Like nobody built their own models back then, right? And so people that built their own models had an edge for a long time, right? But the edge from that today is much smaller than it used to be, right? So then you go another 10 years pass and alternative data started coming around. Nobody had alternative data before, right? But then all of a sudden, first in consumer stocks and then in other stocks, the internet then kind of made its way around. And that was a big edge for a while. And the firms and people that figured that out earlier did amazingly well. And, it's still an edge today, but the edge is much, much smaller, right? Because everybody does it. So that's kind of how I think, AI is the teams that are able to harness that intelligently and combine it. It's not going to make money by itself. They combine it with all the other things they do well. They have an edge. And I think they will for a period of time. It makes you more productive. You can figure stuff out faster. You can get deeper on more names and more concepts. But that's not going to last forever either. So you have to kind of lean into it and, then you figure out the next thing.
Probably a good segue to adapt or die. Is that the same mentality you're applying to technology today? It's just sort of this adapt or die.
Definitely. I think if you look back at the list of largest hedge funds over time, right? It comes out every year. They've had it for a long time. There's been tremendous turnover on that list. And I think it's not unique to hedge funds. It's if you look at the largest companies in S&P, right? So I think if you don't constantly innovate and adapt and try to figure out the new thing and how to implement that and combine it with the rest of your things that you do well, you become mediocre and eventually you get passed up. And in almost every industry, there's a fairly small number of firms that, generate either most of the P&L or most of the alpha in the hedge fund world. And I think this is no different. So, adapting to the markets and adapting to kind of process changes is one of our key, principles. And the teams that do a good job of that tend to, perform year in and year out. Like not every year is a record year, but they're very consistent, and that's constantly because they're reinventing their process all the time. So, we definitely try to do that as a firm to stay on the leading edge.
How do you, I mean, culture is a big thing for you, and I know you spend a lot of time thinking about it. How do you develop a culture that can adapt and is not become bureaucratic? Because you're a big organization with locations around the world versus just a few guys in Chicago when you started in 2001.
Yeah, I think it's not easy. It starts with hiring really good people and being consistent culturally in what you're looking for. So we have a pretty involved interview process where we might take a little bit longer than others to make an offer because we want a number of different folks, both in management and peers, to speak with the candidate. But I think that translates to we're more committed to the candidate when they join, and we understand their strategy and their pluses and minuses better. And through that process, people usually self-select on joining as well, because if they want to be at a place where they kind of sit in the corner and are left alone, like they tend to self-select somewhere else. If they want to be part of a larger team and enjoy kind of talking markets and process, with their colleagues and constantly trying to figure out how to, iterate their approach, they appreciate it and are usually more committed.
Another kind of question for you is just that if you think about your flagship fund is called Atlas. And Atlas is, I believe, derived from Ayn Rand, yep, and another immigrant from the former Soviet Union. How has her work kind of influenced the way you think about investing or life?
Yeah, well, I think in general, like psychology and philosophy are very important to understand where people are coming from, and I think they're integral to people's success or lack thereof over time. If you look at the most successful people in, investing in business and other areas, like they tend to have like a very kind of stable psychology and a very, kind of thoughtful philosophy on what they're trying to achieve. Right. So with Ayn Rand in particular, I read her work when I started in college. I read Atlas Shrugged and then all the rest of her books, and I've reread Atlas a number of times over the years. It basically articulated a moral philosophy of capitalism and life in general. Right, a lot of things that kind of intuitively made sense to me, where a lot of the media or different publications or academia are presented as contradictions of you could make money or be a good person, or you could have a profitable business, or you could help people. Like those are not real contradictions, right? And so she created like a very thoughtful philosophical framework that's presented in very enjoyable fiction books, which are much easier to read than the nonfiction philosophy, and tell the story, and you could really relate to it and kind of grasp it without being PhD in philosophy.
And you also have the Atlas Fellows. I mean, that is. Can you talk a little bit about that and some of the other work that you've done there?
I've always been interested in kind of scholarship initiatives, and we looked around. My wife Rebecca and I looked around at all the different options and programs that were out there, and we didn't find one that combined finance related work and internships and direction with scholarships that weren't, for a particular company. So, a bank might have one where you work for the bank and then you get a scholarship, but then you have to come back and work for the bank, and that's fine, and those are great. But I wanted to do something bigger, where you weren't tied to just coming to work for us. We wanted to find kids who were super smart, super driven, were doing great in school, and we're interested in finance as a potential career, but we're sort of under-resourced in the finance world, whether they're first generation to go to college, or their parents might be in a completely different industry. They might be in a different place where there's no connectivity. And so we combined finance internships, 4 years of paid internships, the first one being at BAM, and then we helped place them with top tier finance firms, hedge funds, VC funds, exchanges, banks over the years, with a college scholarship to help fill some of the need that they have to bridge the gap to go to a top school. And so we started with an initial class that just graduated from college. They all got jobs in finance upon graduation. So that was pretty cool. And we've expanded it. So now there's, I'm going to screw up the number, but I think it's pretty close to 150 people in the program, all on, 4-year scholarships and with 4-year internships. And we're, trying to grow it every year.
That's very cool. Very cool. Final couple questions for you, and we'll let you go. So, what is a book maybe that you would recommend in terms of either investing, culture, or life? And you can't say When Atlas Shrugged or Fountainhead.
Yeah, we have a whole reading list that we give out. So there's a bunch of good ones. I think on trading and markets, I always tell people to start with Market Wizards. I think Jack Schwager does a great job of profiling through very thoughtful interviews a lot of the perennial top performers in the business. So I think in particular the first 2 or 3, he's done like a bunch of different volumes, but like the first 2 or 3 that he did, I read when I was starting out, and they were interviews with a lot of folks that have, were already legendary at the time, but certainly today are. So I would start with that. And I think the interesting takeaways there is the psychological ingredients are pretty consistent across a lot of the participants, but their approaches are completely all over the map, just in terms of what they trade, how they trade, how they risk manage, holding periods, completely all over the map. But the psychological elements of how to be, consistent and come back from drawdowns and, iterating approaches, those tend to be pretty consistent. So I would start with that.
That is a good one. That is on my bookshelf as well. And then last question. I mean, look, you're a family man, which I have. Kids can be stressful at times. You are a founder. You run a hedge fund. Markets can be stressful. What do you do? What are your hobbies that help you distress?
I like to do kind of active stuff that gets your head out of work for a couple hours. So ideally outdoors. So I like to ski. I like to mountain bike. I like to play racket sports, table tennis, padel, stuff like that. Basketball, like anything that is fast paced enough that you can't really do it and think about anything else. Or you're gonna wipe out pretty quickly. So I think it's important to get your head out of the markets and out of work for a little bit and come back refreshed.
You heard you got to love the markets, got to work hard, but occasionally you need to unplug and rest your brain. So That is good advice. Hey, Dmitry, thank you so much for being a part of our podcast today. We really appreciate it.
My pleasure. Thanks, Greg.
If you are interested in more information on FEG, check out our website at www.feg.com. And don't forget to subscribe to our communications so you don't miss the next episode. Please keep in mind that this information is intended to be general education that needs to be framed within the unique risk and return objectives of each client. Therefore, nobody should consider these to be FEG recommendations. This podcast was prepared by FEG. Neither the information nor any opinion expressed in this podcast constitutes an offer or an invitation to make an offer to buy or sell any securities. The views and opinions expressed by guest speakers are solely their own and do not necessarily represent the views or opinions of their firm or of FEG.